To access more advanced researches, applications, and our latest Deep Values agents, welcome to Explore and join Deep Values APP. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Right.
So welcome in, everyone. We are really glad to have you with us today. Today's deep dive is, it's a wild one.
It really is.
Because Microsoft just had the kind of quarter that honestly should make Wall Street break out the champagne. I mean, they completely smashed expectations.
Yeah, absolutely. Crushed them.
Right. They demonstrated this hyper growth in their cloud division. But instead of popping bottles, institutional investors completely panicked, and the stock actually dropped.
Dropped pretty significantly, too.
Yeah. So today we are figuring out why. We're diving into a comprehensive 2026 financial and valuation research report to answer just one massive question for you. Is Microsoft's aggressive transition into a capital-heavy, artificial intelligence behemoth a visionary masterstroke for the next decade? Or are we looking at a dangerous civilizational-scale spending bubble that's just going to end in tears?
A very expensive bubble. Yeah.
Exactly. Okay, let's unpack this.
So to really understand the panic, we have to look at the sheer scale of the top-line numbers they just reported, because they are staggering.
Oh, yeah. The revenue alone is insane.
Right. We are talking about $82.89 billion in revenue for a single quarter.
Which is just, almost $83 billion in 90 days. That is approaching $1 billion a day in revenue.
Yeah, $1 billion a day. And their earnings per share came in at $4.27, which, comfortably beat Wall Street's expectation of $4.07.
That's all feet.
And the real engine of all this, the Microsoft Cloud segment, it hit $46.7 billion, with their flagship Azure platform growing at an astounding 39 to 40%.
Okay, so if the money printer is running that hot and they beat all these expectations, why on earth did the stock drop?
Because Wall Street stopped looking at the money coming in and they just hyper-focused on the money going out.
Yeah.
Despite a 20% overall increase in operating income, the gross margin for the cloud segment actually compressed. It dropped from a historical high of 72% down to 68%.
Wait, let me stop you there and just kind of put on my beginner's hat for a second.
Mm-hmm.
For a software company, gross margin is essentially the holy grail, right?
Oh, completely. It's everything.
It's how much profit they make on their core services before paying for all the corporate overhead. So a 4% drop, it sounds pretty small in everyday life, but in financial terms, what does that actually mean?
Well, in institutional finance, they track this in basis points. And a 400 basis point drop in your core growth engine, that is a fundamental shift in how the business operates.
Oh, wow. Okay.
And the culprit behind this margin compression is CapEx, capital expenditures. To build out the infrastructure required for this generative AI era, management guided a shocking $190 billion in CapEx for the calendar year 2026 alone.
Wait, I'm sorry. $190 billion.
Yes.
In 12 months.
In a single year.
I like to think about this in real-world terms. Imagine you own a highly profitable delivery business using bicycles. And suddenly, you decide to transition your entire fleet to state-of-the-art, million-dollar autonomous delivery trucks.
Right. Huge upfront investment.
Yeah, and you're buying tens of thousands of these trucks before you even know if your customers actually want to pay premium prices for what you're delivering.
Exactly. The upfront cost is astronomical, and the payoff is entirely dependent on future customer behavior that just hasn't fully materialized yet.
Right.
The bulk of that $190 billion is going towards securing advanced GPUs from companies like NVIDIA and AMD and physically constructing the hyperscale data centers to actually house them.
But hold on, let me jump in here. $190 billion sounds like they are, boldly building the future. But reading through the source material, management noted that $25 billion of that 2026 spend is purely the result of supply chain component inflation.
Yeah, the chips are getting way more expensive.
So are they actually expanding their capabilities, or are they just paying a massive premium, getting gouged on prices, just to stay in the game?
What's fascinating here is that Microsoft's executive team is completely aware of this dynamic. They are intentionally absorbing this margin dilution.
Really? Intentionally?
Yeah, it's not an operational accident. It's not a failure to control costs. It is a deliberate structural shift. They are moving away from being a high-margin, asset-light, software company, where you write code once and distribute it globally for practically nothing, and turning into a highly capital-intensive physical infrastructure company.
So they're basically building the digital factories of the 21st century.
Exactly.
And you don't spend nearly $200 billion on factories in a single year unless you believe the economic moat you are building around your business is going to be completely impenetrable.
And the current state of that moat is undeniably massive. Microsoft has 450 million active commercial M365 seats.
Which is pretty much everyone.
It represents virtually the entire corporate world using Word, Excel, Teams, and Outlook every single day.
Meaning all the world's corporate data already lives on their servers.
Right. And the critical data point from the report is how they are leveraging that data. Their premium AI add-on, Microsoft 365 Copilot, just passed 20 million paid seats.
Wow.
That translates to an adoption rate of about 4.4% of their total commercial base.
So embedding state-of-the-art foundational models directly into the workflow where people already do their jobs, that creates some serious ecosystem lock-in.
Huge lock-in.
A Fortune 500 company can't just, unplug its entire global workforce from Microsoft just to try out a different AI tool. The switching costs would be an absolute nightmare.
Ecosystem lock-in is the ultimate bull case here. But the source material provides a very sobering short-term reality check.
Oh. What kind of reality check?
We are currently seeing a staggering statistic across the industry. 95% of enterprise AI projects fail to generate measurable returns in their early pilot stages.
Wait, really? 95% failure on ROI?
Yes, 95%.
Why is it that high? Are the models just not good enough yet? Or
It's actually less about the models and more about the corporate reality. Integration is incredibly complex. Corporate data is often siloed. It's messy. Companies really struggle to define clear, measurable business outcomes for these AI tools beyond just, having them write polite emails.
Right, which doesn't really move the needle on profits.
Exactly. So you have this massive gap. Microsoft is spending capital today at hyperspeed, but the revenue realization, the actual return on investment from their corporate clients is severely delayed.
Okay, so we have a timing mismatch in the short term, but the report also highlights some, frankly, terrifying long-term structural threats to this whole operation.
Oh, absolutely.
The two massive bottlenecks seem to be the depreciation treadmill and the power grid. Let's unpack the treadmill first.
Okay, so the depreciation treadmill is arguably the most severe economic risk highlighted in the analysis. Roughly two-thirds of this $190 billion hyperscale CapEx is going towards short-lived assets.
Things like the GPUs.
Primarily AI GPUs and custom silicon. For accounting purposes, Microsoft tells the IRS and its investors that it will depreciate these assets over 5 to 6 years.
Okay.
But their actual technological lifespan is heavily compressed. It's more like 2 to 3 years.
Right, because the hardware gets faster and more efficient so quickly. It's like buying top-of-the-line smartphones for 100,000 employees.
Yeah.
For tax purposes, you say, oh, they'll last 5 years.
Yeah.
But because the apps and operating systems demand twice as much processing power every couple of years, those phones are essentially bricks in 24 months. You are forced to buy the next generation just to keep the software running.
That captures the dynamic perfectly. You are buying highly expensive assets that become obsolete almost immediately. It creates a permanent, highly capital-intensive treadmill. You have to keep buying new infrastructure just to maintain market parity with Google or AWS.
It's like a technology subscription you can never cancel.
Yes.
If you stop paying for the new chips, your cloud falls behind and your moat dries up, which I guess leads us to the physical limit of all this computing power, the electricity grid.
The grid is a massive, massive problem.
The research notes that a single 1 gigawatt data center carries an $8.5 billion annualized total cost of ownership.
And beyond the monetary cost, it requires immense local grid support. You cannot just, drop a 1 gigawatt data center anywhere.
Right.
It requires specialized power purchase agreements, upgraded transmission lines, and massive, massive amounts of cooling infrastructure.
So I want you, the listener, to really think about this for a second.
Yeah.
Are we going to hit a wall with electricity availability long before we hit a limit on what AI can actually do?
It is a highly probable scenario. Energy, not silicon supply, is rapidly becoming the ultimate limiting factor to cloud expansion. A company can print money to buy more GPUs, but they cannot print a 1 gigawatt power plant.
Yeah. And with all these intense capital constraints, the massive margin dilution, and the sheer physical limits of electricity, a traditional value investor must be tearing their hair out looking at this stock.
Oh, they definitely are.
Let's look at how Microsoft actually stacks up against deep value investing standards. Can a strict Benjamin Graham-style value investor even compute what Microsoft is doing right now?
Well, If you apply rigid, old-school value metrics, Microsoft utterly fails the test.
Completely fails.
Right. Benjamin Graham's philosophy demands strict valuation discipline focused heavily on capital preservation and tangible physical assets. The benchmark deep value standard requires a price to earnings, or PE, ratio of under 15.
Okay.
Microsoft's PE currently sits at 23.41.
And just to clarify for everyone listening, a PE of 23 essentially means investors are willing to pay $23 today for every $1 of earnings the company makes over a year. So Graham would say you're overpaying for that dollar.
Correct. You are drastically overpaying in his eyes. And it looks even worse on the balance sheet.
How so?
Well, the deep value standard for a price to book, or PB ratio, requires a multiple of under 1.5. Microsoft is trading at a PB of 8.15.
Wow. Let's break that one down too. Price to book is basically comparing the market value of the stock to the actual physical assets the company owns if they sold off everything tomorrow, right?
Yes, exactly. And trading at over 8 times its book value means it fails Graham's test spectacularly.
Right.
But, and this is crucial, we have to recognize the limitation of those old rules. Modern software companies generate immense intangible assets, millions of lines of proprietary code, oceans of user data, global network effects.
Stuff you can't just put in a warehouse.
Exactly. Those simply do not show up on a traditional balance sheet like a factory or a piece of machinery would.
So the industrial era rules don't quite fit the digital era. But when the report applies modern quality and cash generation metrics, the story completely flips, doesn't it?
It absolutely does.
Because the numbers here are just wild. They have a 24% free cash flow margin, and they generated $74.5 billion in free cash flow over the trailing 12 months.
It's a money machine. Furthermore, their return on invested capital, or ROIC, is 31.5%.
Wait, let's break that acronym down for a second. Return on invested capital. What does a 31.5% ROIC actually look like in practice for Microsoft?
So it measures how efficiently a company uses the money invested in it to generate profit. A 31.5% ROIC means that for every dollar Microsoft puts into its business, whether that's paying developers or building those expensive data centers, they are generating nearly 32 cents in economic profit above their cost of capital.
That is massive.
That is a phenomenal rate of return, especially while simultaneously funding a $190 billion CapEx cycle. And they also easily pass the Peter Lynch PEG ratio test.
And the PEG ratio, that compares their PE valuation to their actual growth rate, right?
Yes. A PEG ratio under 1.0 is generally considered excellent, indicating that a stock might be undervalued relative to its earnings growth. Microsoft is currently sitting at 0.76.
Okay, so that means their underlying earnings growth is vastly outpacing the premium valuation multiple the market has assigned them.
Precisely.
Okay, so they generate a mountain of cash, but they're spending a mountain of cash. Let's get into the hard math to figure out what the company's actually worth. The report runs a discounted cash flow, or DCF, analysis to find Microsoft's true intrinsic value.
Right, the DCF models.
Before we hit the numbers, give us the simplest possible explanation of how a DCF model actually works.
Okay, a DCF model is essentially financial time travel.
I like that.
It tries to figure out what all the cash Microsoft will make in the future is worth in today's dollars. Because money today is worth more than money tomorrow due to inflation and opportunity cost.
Makes sense.
So, you project out the cash they will generate over the next 10 years, and then you discount it back to today's value based on a specific interest rate. The report ran 3 different projections.
Walk us through the scenarios. Let's start with the worst case.
The first is the no-growth case. This assumes total stagnation. It models a world where the AI monetization thesis completely fails, corporate clients cancel their Copilot subscriptions, and Azure just stops growing entirely.
Just a total stall.
Yeah. Under that highly pessimistic scenario, the intrinsic value of Microsoft is calculated at $149.99 per share.
Which is drastically below where it's currently trading, but I guess it's helpful to know where the absolute floor is. What's the second scenario?
The second is the conservative case. This acts as an aggressive stress test. It simulates a severe macroeconomic depression. It assumes Microsoft's cash flow doesn't just stagnate, but actually shrinks by 8.7% every year for a decade.
Ouch.
Yeah, that apocalyptic scenario values the stock at just $81.05 per share.
Okay, well, let's hope that doesn't happen. And the third model, the one that expects them to actually succeed.
The third is the nominal case. This assumes Microsoft successfully navigates this highly expensive CapEx cycle and maintains the exact historical average cash flow growth rate they have demonstrated over the past 10 years.
Which is what, exactly?
About 13.1% annual growth. That scenario values Microsoft at $402.34 per share.
Here's where it gets really interesting. The current stock price, as of this research report, is $395.50.
Yep.
That is almost exactly the nominal case value of $402.34. So I had to push back here and ask, doesn't this mean there is absolutely zero margin of safety for investors right now?
It absolutely means that.
If the Copilot AI revenue doesn't perfectly offset this $190 billion data center build-out, won't those massive depreciation schedules we talked about just permanently crush future earnings?
If we connect this to the bigger picture, you are seeing the exact tension that caused the institutional panic in the first place. At $3.95 a share, investors are paying for flawless execution. There is no structural margin of safety. It reveals a profound truth about Microsoft's management strategy today. They are not trying to maximize short-term free cash flow yield.
They don't care about looking pretty for value investors this quarter.
Not at all. Their objective is much larger. They are attempting to capture the entire global AI workload layer before Amazon Web Services or Google can scale their infrastructure to meet the demand.
Wow.
It is a high-wire act being performed with a $3 trillion company.
And executing a high-wire act with zero margin of safety requires immense trust from the people backing you. Satya Nadella is essentially asking Wall Street for a decade of blind trust to pull off this $190 billion gamble. How's the leadership team handling that pressure?
Well, CEO Satya Nadella and CFO Amy Hood, they have actively tried to maintain that trust through aggressive transparency. They haven't tried to hide the margin dilution from Wall Street.
They got out ahead of it.
Exactly. They proactively forecasted it months in advance. They are framing it as a deliberate 10-year lock-in strategy. Furthermore, their compensation is heavily tied to performance metrics, and they are still maintaining a massive $60 billion share buyback program to return capital to shareholders.
Though it's worth noting the pace of those buybacks has slightly moderated recently, simply because they need the liquid cash to feed that $190 billion CapEx monster.
Naturally.
And structurally, they do have the backing of Wall Street's heavyweights. 73% of this stock is held by institutional giants like Vanguard, BlackRock, and State Street.
The biggest players in the game.
Yeah, who view Microsoft as a core pillar of the global economy. But, and this is a big but, looking at the recent December 2025 annual shareholders meeting, that trust is starting to crack.
It really is.
And surprisingly, it is not just because of the financial metrics.
No. Two shareholder proposals gained massive, unexpected traction regarding geopolitics and ethics. Proposal 8 demanded a comprehensive report on censorship and human rights risks associated with Microsoft's data centers in Saudi Arabia. That proposal won over 27% of the vote.
Over 27%. That's huge for a shareholder vote. And what was the second one?
Proposal 9 sought a formal assessment of human rights due diligence regarding the potential misuse of Microsoft's AI tools by military or state actors. That secured over 26% of the shareholder vote.
I want you to pause and consider that. Over a quarter of the shareholders voting against the board on human rights issues for a massive tech stock. That is highly unusual.
Extremely unusual.
That shows that the risks here aren't just about microchips and accounting depreciation and profit margins. We are talking about permanent geopolitical and reputational blowback.
Definitely. When a company builds civilizational scale infrastructure across the globe, it ceases to be just a software vendor. It becomes a geopolitical actor. The report explicitly warns that in emerging global markets, regulatory blowback, shareholder activism, or forced market exits could permanently impair their revenue growth trajectories.
Yeah, that makes sense.
If a foreign government decides to seize a localized data center or heavily regulate what a foundational AI model is allowed to output, that directly and permanently impacts the bottom line.
It's the ultimate paradox of scale. The bigger the moat gets, the more physical infrastructure it requires, and the more vulnerable it becomes to the physical and political realities of the world.
Precisely.
Let's pull all this together. We have covered a tremendous amount of ground in this deep dive.
We really have. We are basically looking at a $3 trillion compounding machine that is currently acting with the capital-hungry, hyper-aggressive mentality of an early-stage startup.
Yeah, they're betting $190 billion in 2026 alone. They are risking immense short-term margin compression, all to secure a monopoly on the AI future.
It's a huge swing.
Yeah. They pass modern cash flow metrics with flying colors, but they offer zero margin of safety at current prices. If they are wrong about enterprise AI adoption, or if the costs continue to spiral, the financial consequences will be historic.
It leaves us with a fascinating final thought to consider, returning to that physical power grid constraint we talked about.
Oh, yeah.
If energy availability, rather than silicon, is rapidly becoming the ultimate limiting factor to cloud expansion, will software giants like Microsoft eventually be forced to become massive energy and utility companies themselves?
That is wild to think about.
Right. Will they have to build their own nuclear reactors or solar farms just to keep their AI ambitions alive?
A software company pivoting to become a global power utility. It sounds like science fiction, but given the massive numbers we just walked through, it might just be the inevitable next step. So what does this all mean? It means the future of technology isn't just about code anymore. It's about copper wire, concrete, and watts. Keep digging, keep questioning the numbers, and we'll see you on the next deep dive.